this week is kind of the tech earnings reports. What else are you seeing so far this earnings season, and what are you expecting with the rest of this week?
Well, I think the problem with earnings season, Aaron, is that it's colliding with a super hawkish Fed. And so we've talked about this before. What determines a stock price? Earnings per share times the PE multiple equals stock price. So you have two drivers here, EPS and PE multiple. Now, when you have earnings season, you're going to get some read on EPS, whether EPS should move higher or lower, depending on if companies are beating, missing, meeting. Companies are beating. They're beating by pretty good amounts, around 7-8% on average. So the EPS number is going higher. I mean, it should go higher. Companies are guiding positive too. There's a lot of positive stuff in the earnings season. But it's colliding against a super hawkish Fed that has put the 10-year Treasury yield up to about 3%. It's pulled back over the past couple days to about 2.8%, but I mean it's way elevated. Okay, we were at 1.9 exiting last year, so we've gained 100 basis points plus. Pretty scary. So it's colliding with that, which is bringing the P multiple down. So there's been so much compression, or there needs to be so much compression in the P multiple, that earnings needed to be really, really good to offset the multiple compression to set the stage for stocks to rally. And what you're getting is earnings are good, but not good enough. Not enough positive magnitude here to really offset the multiple compression to set the stage for a stock rally. So stocks are not doing well during earnings season so far. It also hurts when the big boys, when the mega caps don't perform well. Netflix obviously had a horrible quarter. We're going to hear from Google, Microsoft, Amazon. So we'll see over the next 2 weeks. The tune could completely change, because you got to remember we still have a lot of earnings season left. There is a lot of game left in this earnings season. So what we want to do is wait and see how the rest of the companies report. But thus far, earnings season has been good, but not great. We needed great. In the absence of great, stocks are struggling. And that's earnings season in a nutshell so far.
I know you mentioned last week this divergence phenomenon you discussed. Just want to kind of check in with that research and how you're monitoring how that progresses, how that coincides with the current earnings that you're seeing right now.
So we are I was up till 2 a.m. last night, 2:30 a.m., working on the divergence phenomenon, because it is a phenomenon that we are exceptionally excited about. And just to recap for those who are new to this podcast or this show or whatever we call it these days, I don't know, I'm not cool. The divergence is based on the simple idea that over time, the company is the stock and the stock is the company. So if a company is growing very quickly, its revenues and its earnings are trending higher, the stock price too will trend higher. The correlation there is very strong. Between revenues and price, it's 0.88. Between earnings and price, it's 0.93. So you're talking about a 90% positive correlation. Very strong correlation. Every once in a while, though, you get a divergence in this correlation. You get a break in this correlation where the company is not the stock and the stock is not the company. You get brief moments in time where that is true. That normally happens when there's periods of macroeconomic fear, periods of recession fears, periods of elevated volatility, where people start acting irrationally and markets start believing that these companies that are growing very quickly are going to stop growing. But if they don't stop growing, then what you have is this enormous divergence opportunity where revenues and earnings continue to go higher, the stock price drops, and everyone notices a couple months on, wait, those revenues and earnings are still going up. Maybe this stock, let's buy the stock. You get a massive convergence, a massive snapback. These are rare opportunities in the market. We've seen them happen 3 times over the past 35, 40 years. We believe one is emerging right now, and we're hard at work trying to identify the opportunities in that divergence phenomenon, that divergence window. How does earnings season play into this? Well, the companies that we are following for this divergence phenomenon are reporting fabulous earnings.
Okay.
So their earnings trend line, their revenues trend line is continuing to go up and to the right. Meanwhile, their stocks are selling off with in sympathy with the rest of the market and are going down. So the divergence is getting bigger. The bigger this divergence gets, our analysis shows, the bigger the snapback will be. That there is a clear correlation in all the divergence examples we found over the past 35 years. The more divergent a stock is, stock price from its fundamental growth trend line, the quicker it snaps back and the bigger the returns are in that snapback. For example, Amazon was super divergent in 2001. This is a stock that dropped 92, 93, 95%, maybe it was more. Dropped more than 90% from 2000 to 2001. Absolutely got crushed. And its revenues at that time continued to soar, absolutely soar. That was one of the biggest divergences ever. And it resulted in enabling you to buy Amazon stock at like $5 or $6. And what it was a $3,300 stock not too long ago. So we're talking about generationally strong buying opportunities here. And we believe something like that is happening right now, and we're monitoring the data very closely to see when exactly is this window going to open, when are we going to bottom out, when's the snapback going to begin. But the divergence is here, and that is a really promising setup for long-term investors.
Are there any upcoming earnings that you're going to be looking at closely for the rest of earnings season?
I look at all the earnings, Aaron. I look at
all the earnings. Okay.
No, they're all important, especially this time around. You want to look at tech to see, okay, is there a pull forward of demand, or was there a pull forward of demand? Are they continuing to grow at the rates that analysts expect them to? You got to watch the tech earnings. You got to watch the consumer spending earnings. You got to see consumer discretionary and consumer staples. Consumer discretionary is important because you want to see, okay, is the consumer so afraid that they're not spending? Because consumer sentiment keeps dropping. It's at super low levels, yet consumer spending has remained pretty strong. So you want to watch consumer discretionary earnings to see how is the consumer spending during this time. Despite what their sentiment may be, what are their spending trends looking like? Look at consumer staples to see, okay, those are the folks that should have the most pricing power. They should be able to absorb inflation the most, pass on those costs the most. They should be able to preserve their margins the most. Is that true? If not, probably worrisome for everybody else. So you got to look across. You want to watch the oil companies, right? The oil stocks. How are they reporting earnings right now? What is their outlook? Are they building more? Are they expanding their production out? Is that going to impact supply? So across the board, this earnings season is very important to the market, regardless of what you're invested in, because it's all interconnected. And right now we're in exceptionally volatile times, meaning everything counts. Everything matters. So when you ask me, are there any earnings I'm looking for, I'm paying attention to, it's all of them, Aaron. Really, it's all of them right now.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.